I'm going to tell you about a man named Richard. In 2011, Richard did something his family thought was crazy. He took $127,000, nearly his entire retirement savings, and bought gold at $1,800 an ounce. 3 months later, gold crashed. By 2015, his $127,000 had become $68,000. His wife was furious. His kids thought he'd lost his mind. Richard couldn't sleep. Every night, he'd lie awake, wondering if he should just sell, take what was left, and admit he'd made the biggest mistake of his life. He came within one click of selling everything at the bottom, but he didn't. Today, Richard's position is worth over $340,000. He retired comfortably. His wife admits she was wrong. His kids now ask him for investing advice. But here's what most people miss about Richard's story. It wasn't luck. It wasn't stubbornness. It wasn't blind faith. Richard had a system, a decision-making framework that told him exactly what to do when the crash happened. He didn't panic because he didn't have to think during the chaos. He'd already decided what to do before the crash ever occurred. Now, after what just happened in gold and silver, you're facing the same decision Richard faced. Hold what you have, buy more at lower prices, or wait for further clarity? I'm going to give you the exact framework to answer that question. Not generic advice, not, it depends, a specific, actionable decision system based on your actual situation. But here's what I need you to understand first. The answer is different for different people. What's right for you depends on factors most financial content never addresses. And if you get this wrong, if you make the wrong choice for your specific situation, you could be setting yourself up for years of regret. By the end of this video, you'll know with clarity whether you should hold, buy, or wait. Not because I told you what to do, but because you'll have a framework that tells you what's right for your circumstances. Stay with me. This is important. Welcome to the silent economy. Retention goal. Build the decision framework, create aha moments, tease specific answers coming. Here's why most people make terrible decisions after market crashes. They ask the wrong question. Should I hold, buy, or wait? Sounds like a simple question. But it's actually 3 questions disguised as one. And the answer to each depends on variables that are completely different for every investor. Let me show you what I mean. Imagine 2 investors. Let's call them Sarah and Michael. Sarah is 34 years old. She has a stable job. Her precious metals position is 8% of her total portfolio. She has 6 months of emergency savings in cash, and she won't need this money for at least 20 years. Michael is 58 years old. He's planning to retire in 3 years. His precious metals position is 40% of his portfolio. His emergency fund is thin, and he was counting on these metals to fund part of his retirement. Now, should Sarah and Michael do the same thing after this crash? Obviously not. What's a brilliant move for Sarah could be catastrophic for Michael. What's prudent for Michael could be an enormous missed opportunity for Sarah. This is why generic advice is dangerous. This is why buy the dip without context can ruin people. This is why you need a framework, not a prediction. Here's the framework. There are 4 variables that determine your correct answer. Not 3, not 5, 4. Get these 4 right, and your decision becomes obvious. Variable 1, your time horizon. How long until you actually need this money? Not when you'd like it to grow, when you'll actually need to spend it. If your time horizon is over 10 years, you're playing a completely different game than someone who needs money in 2 years. Variable 2, your current allocation. What percentage of your total wealth is in precious metals right now? 5%, 20%, 50%? This determines whether the crash was a minor portfolio fluctuation or a significant wealth event. Variable 3, your financial stability. Do you have emergency reserves? Is your income stable? Could you survive a financial shock without touching your investments? This determines whether you're investing from strength or vulnerability. Variable 4, your conviction level. Do you understand why you own precious metals? Do you believe in the long-term thesis, or were you just following the crowd? This determines whether you'll have the psychological capacity to execute whatever decision you make. Now here's what I'm going to do. In the next section, I'm going to show you how each combination of these variables produces a different answer. Hold, buy, or wait. Clear guidance based on your specific situation. But first, I need to show you something that will completely change how you think about this decision, because what most people believe about crash behavior is dangerously wrong. Retention. Goal, challenge assumptions, provide counterintuitive insights, build toward the decision matrix. Here's what conventional wisdom tells you. Buy when there's blood in the streets. Be greedy when others are fearful. Every crash is a buying opportunity. This advice has become so common that it's lost all meaning. And worse, it's incomplete in ways that destroy people. Let me show you why. In 1980, gold crashed from $850 to $300. Classic blood in the street situation. Buy the dip, right? If you bought at $300, you waited 25 years to see meaningful gains. 25 years of your life waiting. In 2008, gold crashed from $1,000 to $680. If you bought that dip, you tripled your money in 3 years. Same advice. Buy the crash. Radically different outcomes. What's the difference? Here's what nobody talks about. The right decision after a crash depends entirely on what caused the crash. There are 3 types of crashes, and each requires a completely different response. Type 1, liquidity crashes. These happen when investors need to sell everything to raise cash. March 2020 was a perfect example. The financial system was seizing, everyone was selling everything. Gold crashed alongside stocks because people needed dollars, not because gold had problems. Liquidity crashes typically reverse quickly, days to weeks. They're often excellent buying opportunities because nothing fundamental has changed. Type 2, positioning crashes. These happen when speculative excess gets unwound. Too many leveraged longs, then a trigger event, then cascading liquidation. We've seen many of these. They're mechanical, not fundamental. Positioning crashes can take weeks to months to fully resolve, but they often set up significant rallies once positioning resets. Type 3, thesis crashes. These are the dangerous ones. These happen when something fundamental changes. The reason to own the asset has genuinely weakened. Thesis crashes don't recover until the thesis becomes valid again. This can take years, or never. The 1980 crash was partly a thesis crash. The Fed, under Volcker, genuinely broke inflation. Real interest rates went to 5%, 6%, 7%. The fundamental case for gold weakened dramatically. It took decades for conditions to become favorable again. Now, here's the critical question. What type of crash just happened in gold and silver? I've analyzed the data, I've studied the positioning, I've examined the fundamental drivers, and I'm going to show you exactly what type this crash was, because that determination changes everything about whether you should hold, buy, or wait. But that analysis only matters once you understand your personal variables. So let me give you the decision matrix first, then we'll apply it. Here's the decision matrix. This is the framework that tells you what to do. I'm going to walk through each scenario. Find the one that matches your situation. That's your answer. Scenario 1, long time horizon, moderate allocation, stable finances, high conviction. This is the sweet spot for accumulation. If you have 10 plus years until you need this money, if precious metals are 15% or less of your portfolio, if your financial life is stable, and if you genuinely understand why you own metals, the answer is clear. Buy, accumulate, add to your position. Lower prices mean more ounces per dollar. You have the time to wait for recovery. You have the stability to not need the money. You have the conviction to hold through volatility. This is the Richard scenario. This is how he won. Scenario 2, long time horizon, moderate allocation, stable finances, low conviction. This is the confused investor scenario, and it's more common than you'd think. If you bought precious metals because someone told you to, because of a YouTube video, because of fear without understanding, and now you're panicking, you have a conviction problem, not a gold problem. The answer here is hold but educate. Don't sell in a panic. But use this time to genuinely understand why precious metals exist in portfolios. Read the history, understand the thesis, build genuine conviction. If after education you still don't believe, consider a gradual exit on rallies, not a panic sale at lows. Scenario 3, long time horizon, heavy allocation, stable finances, high conviction. This is the overconcentrated believer. Dangerous territory. If precious metals are 40%, 50%, 60% of your portfolio, even with high conviction, you're taking concentration risk that can destroy you psychologically and financially. The answer here is hold current position, but don't add. Consider rebalancing on any significant rally. Your conviction may be correct, but your sizing is inappropriate for long-term wealth building. Concentration creates fragility. Scenario 4, short time horizon, any allocation, any stability. If you need this money in less than 3 to 5 years, the calculus changes completely. Short-time horizons cannot survive extended drawdowns. Bear markets in precious metals have lasted years. If you need the money soon, you can't wait for recovery. The answer here is hold what you have, but don't add. Consider whether your allocation is appropriate for your actual timeline. This isn't about conviction. It's about matching assets to time horizons. Scenario 5, any time horizon, any allocation, unstable finances. If you don't have emergency reserves, if your income is uncertain, if you're financially stressed, precious metals investing should not be your priority. The answer here is hold, but build stability first. Any money you'd use to buy more should go toward emergency reserves. Investing from a position of weakness leads to forced selling at the worst times. Scenario 6, long time horizon, underallocated, stable finances, high conviction. This is the ideal buying scenario. If you've been wanting to build a precious metals position, if you're currently below your target allocation, if you have the stability and conviction to hold through volatility, post-crash prices are advantageous. The answer here is buy systematically, not all at once. Staged purchases over weeks or months, dollar cost averaging into your target allocation. Scenario 7. Any profile, leveraged positions. If you're holding leveraged ETFs, futures, or margin positions, different rules apply entirely. Leverage adds time sensitivity even to long-term investors. Margin calls don't care about your conviction. The answer here is reduce leverage to sustainable levels. Survivors don't use leverage in volatile assets. Now, let me show you something crucial. These scenarios assume you know what type of crash this was. Let me give you that analysis now. Retention goal. Apply framework to current situation, provide specific analysis, build toward conclusion. Let's diagnose this crash. Evidence. For liquidity. Crash. We saw signs of forced selling, volume spikes during the decline, indiscriminate selling across asset classes at certain points, some correlation with broader market stress. But liquidity crashes are typically brief, violent down, then quick recovery. This crash showed more extended behavior. Conclusion? Partial liquidity component, but not purely a liquidity event. Evidence for positioning. Crash. Before the crash, speculative long positions had grown significantly. The commitment of traders' data showed elevated managed money longs. Commercial short positions had expanded. During the crash, we saw classic forced liquidation patterns, margin call-driven selling, leverage positions being unwound. The positioning reset has been meaningful but not extreme. Conclusion, strong positioning crash component. The speculative excess was being cleared. Evidence for thesis. Crash. Has anything fundamental changed about why people hold precious metals? Government debt levels, still at historic highs and growing. Central bank purchasing, still at record pace, uninterrupted. Currency debasement risk, still present given debt mathematics. Geopolitical tensions, still elevated globally. Real interest rate trajectory, potentially shifting toward more favorable overall diagnosis. This was primarily a positioning crash with some liquidity elements, not a thesis crash. What does history tell us about positioning crashes? They reset speculative excess. They create better entry points. They typically resolve over weeks to months, and they often precede significant rallies once positioning normalizes. This is important information for your decision, but here's what matters more. The diagnosis tells you about the market. The decision matrix tells you about yourself. Your answer comes from combining both. Retention. Goal, concrete actions, personal application, prepare for close. Let me give you specific actions based on everything we've covered. If you should hold. Holding is not passive. Here's what active holding looks like. First, stop checking prices daily. Price obsession during volatility creates emotional decisions. Check weekly at most. Second, reconfirm your thesis. Write down why you own precious metals. Read it when doubt creeps in. Third, set alerts, not watches. Set a price alert for levels that would change your analysis, then ignore the noise between. Fourth, focus elsewhere. Put your attention on income, savings rate, career. These affect your wealth more than gold's daily fluctuations. If you should buy. Buying after crashes requires discipline. Here's the system. First, determine your target allocation. What percentage of your portfolio should be in precious metals? Set a specific number. Second, calculate the gap. How much would you need to buy to reach that allocation at current prices? Third, divide into tranches. Split your purchase into 4 to 6 smaller purchases over 2 to 3 months. This reduces timing risk. Fourth, automate if possible. Regular purchases on a schedule remove emotion from execution. Fifth, buy what you'll hold. Physical metal or long-term vehicles, not leveraged products or trading instruments. If you should, wait. Waiting doesn't mean doing nothing. Here's what active waiting looks like. First, define your wait conditions. What specifically would change your answer? Write it down. I'll buy if price reaches X, or I'll buy if my emergency fund reaches Y. Second, prepare capital. Have the money ready so when conditions are met, you can act quickly. Third, continue education. Use the waiting period to deepen understanding of precious metals, monetary policy, and market mechanics. Fourth, set a review date. Don't wait indefinitely. Set a date to reassess, regardless of what price is done. Let me bring this back to Richard. When gold crashed in 2011, Richard didn't have to think about what to do. He'd already built his decision framework. He knew his time horizon was 15 plus years. He knew his allocation was appropriate. He knew his finances were stable. He knew his conviction was genuine. The framework told him, hold, so he held. When gold kept falling through 2013, 2014, 2015, he held. Not because he was stubborn, because his framework said nothing had changed. When everyone told him to sell, he checked his framework. Time horizon? Still long. Allocation? Still appropriate. Finances? Still stable. Thesis? Still valid. Hold. Today, Richard doesn't regret those dark nights. He's grateful for them. They taught him that framework beats emotion every time. Now you have the framework. You know the 4 variables. You know the 7 scenarios. You know what type of crash this was. You know the specific actions for each path. The decision isn't something I can make for you, but I've given you everything you need to make it for yourself. So let me ask you directly. Based on your time horizon, your allocation, your financial stability, and your conviction, what does your framework tell you? Drop a comment below. Tell me which scenario matches your situation. Tell me what decision you've made. I read every single comment, and I'll respond to questions. If this framework brought clarity to a confusing moment, subscribe and hit the notification bell. Next week, I'm breaking down exactly how to execute accumulation strategies during volatile markets, the specific techniques that professional investors use to build positions without emotional interference. One decision today can echo for decades. Make it with clarity, make it with framework, make it without panic. Thanks for watching. This is The Silent Economy, and we'll see you in the next one.